How's it going, everyone? Welcome to the next episode of the Pip Catcher's Mentorship of the Pip Catcher Expeditions. Today we're going to be going over daily rebalance theory, and this is understanding price action and how to anticipate it. Topics of focus. So today we're going to be going over how price targets certain things in the market, the certain actions that the market does, how the market rebalances the market when imbalanced, how we can take advantage of this to our own entries, understanding how to read and anticipate the market actions, introducing macro times, understanding how macro times work, lining up macro times with rebalancing theory, what to look for, types of imbalances, and types of rebalances. Okay, so we're going to go over these section by section, and we're going to go into depth of each of these, okay? So, market's intentions. The market will do one of three things: take out liquidity, fill liquidity, or balance liquidity. Okay, so now when it takes out liquidity, this is either sweeping buy side or sell side liquidity, a turtle soup, or a stop hunt or a stop raid. Okay, so remember, sweeping buy side or sell side liquidity is trading above an old high or equal highs, or trading below an old low or equal lows. And remember, when you trade above those two, you're going to have failed displacement, which is having a failure to have a body close over those highs or under those lows, okay? So that is failed displacement. So having a wick close over a high or a low, that is failed displacement. A turtle soup, however, it's a different type of taking out liquidity. So on a turtle soup, this is when you're tapping into a higher time frame PD ray. So let's say you're tapping into a daily BISI. Right, the market trades down, taps into a daily BISI on the higher time frames. But on the lower time frames, what it's doing, it's creating an intermediate term low, or a major swing low of a range, and it's failing to displace over that low. So what it means is, on the lower time frames, it creates a low, and then on that next low that it creates a higher low, or having failure to displace over that low that it just created. So again, a turtle soup is when you tap into a higher time frame PD ray on the higher time frame, so like the daily chart, and then let's say on the 5-minute chart or the 15-minute chart, you create a low, and then you have failure to displace underneath that low, which means you're failing to trade over that low. Okay? Now, on a stop hunt or a stop raid, that is basically sweeping buy side or sweeping sell side. It's just another name for it. Okay? Next, market will do one of three things. We just went over it takes out liquidity. The next thing that the market can possibly do is fill liquidity. And this is mitigating inefficiencies. So remember when we talked about fair value gaps? Those are inefficiencies. Okay? So fair value gaps are inefficiencies. So a BISI, a SIBI, or even an inverse fair value gap, those are all inefficiencies, okay? So filling any inefficiencies are a type of filling liquidity. And the final thing that we can do, or that the market can do, okay, remember the market can do one of three things: take out liquidity, fill liquidity, or balance liquidity, okay? So when we balance liquidity, we are filling and closing in imbalances, okay? So what this means is when we're closing imbalances, again, fair value gaps are another type of imbalance. Fair value gaps are imbalances, and fair value gaps are also inefficiencies. So when price balances an inefficiency, that means it closes inside the gap, and then it rejects it. Okay, it doesn't close past the gap. It doesn't close before the gap. It closes in the gap, and then it trades in the opposite direction, meaning it rejecting it. So that is filling and closing an imbalance, and that is balancing liquidity there. Another type of balancing liquidity is trading from premium to discount, or trading from discount to premium. Okay, so if you're in premium and then you trade into discount, and the market trades into discount, price just became balanced from doing that. If price is in discount and then the market trades into premium, market is balanced from that as well. Another type of balancing liquidity is trading into equilibrium from premium or discount. So say we're in premium and then we traded to midpoint of the range, that's equilibrium. Price is balanced. If you're in discount and price trades up into midpoint of the range, which is equilibrium, price is balanced, okay? And the final way of balancing liquidity is creating a BPR, which are two aligned fair value gaps that are opposite of each other, which is a BISI and a SIBI aligned, or a SIBI and a BISI aligned, okay? So, intro to ICT macros. So, what are ICT macros? ICT macros are specific time intervals throughout the day that we can use to anticipate market actions for an edge over the market. In these macro times, the market will do one of three actions, which is targeting to take out buy side or sell side liquidity, fill any inefficiencies, or rebalance price. These will be the specific time intervals that you can look for and line up with quarterly theory. So with macro times, you can use these small time intervals throughout your trading sessions for whatever setup that you are anticipating, because when these macro times happen, they're going to do one of those three things, which is take, fill, or balance liquidity. Also at the same time, you can use these macros in line with your 90-minute quarterly theory cycles, okay? So with quarterly theory, you have your 90-minute cycles. You can align your macro times with those cycles, okay? Okay? So these are the ICT macro times, okay? So, the ICT macro times intraday. So, started from London session, going all the way to ICT final hour macro, okay? So if you trade London, make sure you guys write these things down, okay? If you're trading London session, the macro time is from 2:33 a.m. to 3 a.m. Eastern Standard Time, and this is the first macro during London session. The second macro time is from 4:03 a.m. to 4:30 a.m. Eastern Standard Time, and that is the last macro time of London session. After that, we have London session lunch hour, and then when New York AM session happens, the first macro time that starts is 9:50 a.m. to 10:10 a.m. That's the first macro time. Second macro time is from 10:50 a.m. to 11:10 a.m. Eastern Standard Time. And that's the last macro time of New York AM session. After New York AM, we have New York lunch hour from 12 to 1. After that, we have New York lunch macro hours, which is in that time frame, which is from 11:50 to 12:10. So 11:50 a.m. to 12:10 p.m., which is during lunch hour, okay? For New York PM macros, the macro time is from 1:10 p.m. to 1:40 p.m., okay? After that, the next macro time for New York PM sesh, okay, that'll be from 3:15 p.m. to 3:45 p.m. And the final hour macro, okay, so ICT's final hour macro, it's from 3 o'clock p.m. to 4 o'clock p.m. So it's a 1 hour macro from 3 to 4 p.m., okay? So, I'm going to give you guys two cheat codes here about two of these macro times, okay? And let's go in order, okay? So, the cheat code about the New York lunch hour macro. So, the New York lunch macro. If all throughout New York AM session, okay, so throughout the whole New York AM session, throughout all the macros as well, if there has been no distribution move, okay, so no distribution move. So what does this mean? So, accumulation, manipulation, distribution, the power of three, right? AMD. If there is no distribution move during the whole New York AM sesh, this is what's going to happen. The market is going to do two things here. The market is either going to take liquidity during this macro hour, and then you're going to have the distribution move during lunch hour. Or what's going to happen is you're going to take liquidity right before the macro time. And then when it takes liquidity right before the macro time, once the macro time starts, what's going to happen is that the macro time is going to have the distribution leg. Okay? So again, let's go over this one more time. During New York lunch hour macro, okay? So if there's been no distribution leg during New York AM session, if there's been no distribution leg, the market is going to do one of two things. the market is going to either take out liquidity during New York lunch hour macro, so between 11:50 and 12:10, market is going to take out some type of liquidity, and then it's going to have the distribution move during lunch hour, which is from 12 to 1. If it doesn't do that, what it's going to do is going to take out liquidity before the macro time, and once the macro time starts, it's going to have the distribution move during New York lunch hour macro, which is from 11:50 a.m. to 12:10 p.m. Okay? So that's the first cheat code. The second cheat code is that during ICT's final hour macro, so between 3 p.m. and 4 p.m., the market is going to do one of two things. It's either going to retrace back into the range, right? It's going to do that, tapping into whatever PD ray in the range that it wants to. Or what it's going to do, it's going to take out that last bit of buy side or sell side liquidity that it needs to do. Okay? So it's going to do one of those two things. It's going to retrace back into the range, into like a PD ray or something, and then continue to consolidate back in the range until the session is done. Or it's going to take out whatever liquidity is left available for it, so its last push to take out liquidity between 3 p.m. and 4 p.m. Okay? So let's go over the first example of rebalancing. So rebalance A. This is where price creates a fair value gap on the open of the candle, then closes the gap before the candle closes, creating the imbalance before the candle closes and rebalancing before the candle closes. Use this on the daily chart for focus. Happens with majority of candles, okay? So if you think about a fair value gap, right? Think about a fair value gap. So 1, 2, 3. Once this candle opened, remember, on bearish candles, so down closed candles, the candles open at the top of the body, right? To trade lower. On bearish candles, the candle opened here. When the candle opened, it created a fair value gap. So right at candle open, the market created a fair value gap. So once the candle opened, the market created a imbalance. So whenever you have a fair value gap created, you have an imbalance in price. Okay? So because of that, there's been an imbalance of price between this wick and this candle's, whatever it formed here. But because it's imbalanced, what does price want to do? It wants to rebalance price so that price is balanced. So the first example of rebalancing price is the market creating a fair value gap at the open of the candle. But before the candle can close, it closes the distance between this candle and this wick. So it closes the gap in, turning that imbalance of price to balanced price. So that when the market close, or that when the candle closes here, there's no imbalance in this area. And this happens majority of the time on the daily chart. Okay? And that's the first example of rebalancing price. The second example of rebalancing price is price creates an imbalance after the third candle, creating a fair value gap. Price later closes into the gap to then reject away from it. Okay? So if we look at this first example here, so the first model on top, we see we have an imbalance here, which is a fair value gap, right? We have a BISI here. Market trades up, market comes back down, closes inside the fair value gap to then reject higher. Same thing here, we have an imbalance here. Market trades down into it, didn't close into it. Market trades down here, closes a little bit past it though. But let's look at this here. Market trades down into it, then rejects higher. Okay? Then we look at this SIBI here. Market trades up into it, closes inside the fair value gap, and rejects lower. Okay? So let's go over this. Let's look at the second model. Price creates this fair value gap. So every time a fair value gap is created, what is that? It's an imbalance in price. It's an inefficiency. So for price to be balanced, what does it need to do? It needs to fill in this gap. So what does price do? Fills it in here, 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 and then rejects off of it. So when price creates the fair value gap, price is imbalanced. When price fills the fair value gap, price is balanced. When price rejects it, price is rebalanced. Okay? So you go from imbalance to balance to rebalanced. Okay? So imbalance, balance, rebalance. So when the fair value gap is created, that's an imbalance. When the fair value gap is filled, that's balanced. When the fair value gap is rejected, it's rebalanced, okay? So we got imbalance, balance, and rebalance, okay? The next example of rebalance, so rebalance C, price creates a trading range or creates a leg of price, which is from a high to a low or from a low to a high. Market trades into premium or discount of the range. Price then retraces into balancing price at equilibrium. Okay? So, if we have our premium and discount set, so in this consolidation high, consolidation low here, this should say consolidation low, we have our premium and discount. In the midpoint of the range, we have our what? Equilibrium. For price to be balanced in premium, price needs to reach equilibrium. So price taps equilibrium to get into discount. Premium becomes balanced, price wants to go to discount, then goes to discount. Price wants to be balanced, price becomes balanced, comes back into premium, same thing back and forth. So every time price wants to go from premium to discount, or discount to premium, price needs to retrace through equilibrium to get there first. And every time it does, price becomes balanced because of that. Okay? Now, as a market maker, okay, so smart money, as a market maker, you want to be targeting discount if you are in premium. As a market maker, you want to be targeting premium if you're in discount. And the only way to get from one side to the other is through equilibrium. So there is an indefinite purpose of equilibrium, and that is to balance price. And that has to happen for going from premium to discount or discount to premium. Without it going through equilibrium, there's no other way to get to the other side. Okay? And finally, we have the final example of rebalancing price. So rebalance D. Price creates a BPR slash balance price range. So a balanced price range is when you have two fair value gaps that are aligned across from each other. And this can be a BISI plus a SIBI or a SIBI plus a BISI. With these two across from each other, this is balanced price range. This is a balanced price range. So if you have a buy side, so looking at the example, we have a BISI and we have a SIBI. So if we have a buy side imbalance, sell side inefficiency, we have a sell side imbalance, buy side inefficiency, there are two opposite imbalances of each other. So one imbalance plus another imbalance creates balanced price. So because price is balanced here, price is going to be more attracted to this BPR than it is a regular fair value gap. So price is more attracted to rebalancing balanced price than it is to rebalancing imbalanced price. Okay? Now obviously price wants to be balanced all the time, okay? It doesn't want to be imbalanced, it wants to be balanced. And it wants to rebalance it automatically. That's the algorithm, okay? So BPRs, I would say, is one of the most strongest fair value gaps because you have balanced price inside of an inefficiency. So remember that a BPR is one of the strongest fair value gaps. So keep that in mind. And finally, these are the things that you want to keep in mind, okay? And make sure you write these things down, okay? Fair value means price hasn't been in that area for long enough. Hence the name fair value gap. Okay? So, let's break this down. Fair value means price hasn't been in that area for long enough. So if we look at a fair value gap and we look at that space in between the first candle's wick and the third candle's wick, right? Price didn't have enough time to close the gap in between that, which creates an imbalance. So price wasn't in there long enough to balance price. So because price wasn't in there long enough, price became imbalanced. Hence the name imbalance. So having that fair value in there means there's a gap of fair value. There's a gap of price not being there long enough. So because of that, that caused an imbalance. Okay? So that's why the name is called a fair value gap. There's a gap of fair value. There's a gap of not enough time in that area. There's a gap of imbalance in that inefficiency. Okay? The fair value gap is powerful and won't go away. So the fair value gap is one of the most powerful PDRAs. Number one reason it's a very powerful PDRA is because it's an imbalance of price. And price always wants to balance itself. It never wants to be imbalanced. So before price can move in one direction, it needs to balance price before it can continue in the intended direction. If price is imbalanced on one side and it doesn't want to balance it anymore, then it'll show that to you through other ways or other concepts. But for price to go in one direction, price needs to be balanced. If the algorithm wants to go bearish, it needs to balance price first. If the algorithm wants to go bullish, it needs to balance price first. And for it to do that, they use these fair value gaps to catch extra liquidity to continue going in the algorithm's intended direction. Okay? Imagine liquidity being fuel for the market. Without fuel, it can't continue in its direction. So these fair value gaps are little bits of fuel that it can pick up on the way there. Okay? So, study the last 3 daily candles. Study the open, study the high, study the low, study the close of those candles, okay? So study those 3 of the last 3 daily candles, and you can mark those out. The reason for that is you want to see how price reacted with those 3 candles. Did it cause an imbalance? Did it fill that imbalance throughout the day? Did it create an imbalance the next day? Did it fill that imbalance right away? Or did it create an imbalance for that whole day until the next day after that? What did it do? You want to observe it. This is known as tape reading, or not tape reading, but going back to past data. It's an example of, it's not pure back testing, but it is a form of, I would say, just gaining experience because you're studying past data in the markets, okay? Now, you can do this with back testing with the replay mode in hindsight, but you need to do this in a form of going from higher time frame to lower time frame, studying it that way, okay? But make sure you study the last 3 daily candles, because knowing this will help you identify what price wants to balance and what price has balanced already, okay? A fractal is a small piece or a small segment of price action that will continuously reoccur in the market time and time again. So fractal means something that reoccurs in the market. A fractal is a piece of something in the market that reoccurs over and over again. Okay? So whenever you see a fair value gap that continues forming bullishly, so you can see BISIs forming over and over again. So again, a BISI, again a BISI, again a BISI. Or if you're bearish, again a SIBI, again a SIBI, a SIBI, a SIBI. Those small fractals, okay, those give us extra opportunities to take on trades. Now, some of these gaps might get tapped in, as you can see in the real market, but these are opportunities that the market gives us for what? Trading opportunities. So say we missed our first entry of a fair value gap. Usually what the market will do is it'll give us a fractal gap for a second entry or a forgiving entry. And those fractal gaps we can use as scaling opportunities as well for pyramid scaling, which I'll go over in another video. But fractals we want to keep in mind. So they are forgiving entries or secondary entries, or they are pieces of price action that will reoccur, basically. Okay? And price is fractal. So remember that. Price is always fractal. Things in price action will always reoccur. They won't not reoccur. They will always reoccur, okay? And premium market makers seek discount, which is buying at the cheapest price. And discount market makers seek premium, which is selling at paramount price, okay? So if you are a market maker and you're in premium, you want to buy at discount because that's the cheapest price for whatever market that you're buying at. If you're in discount and you're a market maker, you want to seek premium because you want to sell whatever price that you have it at the most expensive price. So whatever, like if you're trading stocks, if you have shares, you want to sell your shares at the most paramount price, the most premium price, because you get the most out of whatever you're selling it for. If you are trying to buy, you always want to buy when it's cheaper. Okay? Now, in a range or a leg of price, the market will balance itself by seeking premium and discount because it must cross over equilibrium. So like I said before, price is inevitable to balance itself automatically from going from premium to discount or discount to premium because they have to cross over equilibrium. It is a must. That's why equilibrium is important to understand, because if price wants to do one of three things, remember, take liquidity, fill liquidity, or balance liquidity. When it's balancing that liquidity over equilibrium, once it reaches equilibrium, price is rebalanced already. And it has to go through there from going from premium to discount or discount to premium, which is why it's inevitable for it to happen. So, for example, if you're in premium, price is rebalanced by targeting discount and trading into equilibrium. So remember when we're in a fair value gap, right? Remember when we create a fair value gap. When we create a fair value gap, price is imbalanced. When price trades into it, it is balanced. When price rejects it, it's rebalanced, right? Same thing here. If you're in premium, you are imbalanced in the market. If you trade into equilibrium, you are balanced in the market. If you trade through equilibrium all the way to the opposite side into discount, you are rebalanced. Okay? And then you go back and forth doing that. Back and forth, back and forth, back and forth. Okay? And that is how price has rebalancing theory. Going from imbalance to balance to rebalance. Imbalance, balance, rebalance. Imbalance, balance, rebalance. And just continuing to do that. Price is always going to try and balance price. Okay? And lastly, what is the importance of knowing rebalancing theory? It is so we can understand and anticipate what the market is targeting to, again, do one of three things, which is take, fill, or balance liquidity. Okay? So, price wants to do one of those three things, which is take, fill, or balance liquidity, correct? So because of this, price wanting to do one of those three things, we can understand on not only the higher time frames, but also on the lower time frames, what the market is targeting. So if we wonder, if you ever traded one of these days, you ever live traded and you're like, why is the market going down? Or why is the market going up? Or why is the market doing this? Why is the market doing that? Why is the market doing this? You can see what the market had filled and rejected. What price had balanced on the higher time frames. Or even on the lower time frames. What has price balanced? Where is there an imbalance in price? Where has price balanced price? And you can see what price has respected, what price has rejected, where you can see the reactions off of it. So, you might ask yourself, how can I get better at understanding this? There's a simple question, or there's a simple answer to that. Two things: back testing and tape reading. Tape reading is the easier one. Back testing is the harder one. So I'm going to explain to you guys how to tape read. So when you tape read, what you are doing is, so when you live trade, you look at the charts, right? You identify stuff. You are looking at what price is doing. With tape reading, you are doing the exact same thing. The only difference is you're identifying reactions. You're looking at the reactions of price. Now, you should be doing this during your live trading, but what you're focused on is making money when you live trade. So your focus is off of what's happening with the candles. What you're actually focusing on is what? Money. And that comes with skill and experience to be able to what? Separate yourself from the money. So, what I'm talking about is, when you tape read, you're not going to be trading at all. You don't trade, and you identify what's happening in the market. You look at the reactions in the market, and nothing else. What you can also do is you can write down notes. So for example, this is something you can write down when you tape read. You can explain something like this, okay? This fair value gap, or this BISI just got tapped into. This BISI got rejected. This BISI got respected. You can talk about it like that. You can also talk about fair value gaps and order blocks and breaker blocks. You can talk about buy side and sell side liquidity. You want to talk about what price has done to buy side and sell side liquidity. Has price taken liquidity? Do you think price is going to take liquidity? Do you anticipate it on happening? Did price respect that fair value gap? Did price reject that fair value gap? Is price going to disrespect that order block to turn into a breaker? Is that breaker a mitigation block, or is it a breaker block? What is it? What time is the macro time happening right now? When is the open? What session are we in? So just identifying all these concepts together, get you familiar and in tune with these concepts. So tape reading is an easy one you can do to gain experience. And dedicating at least an hour of tape reading a day will help you with that. And that'll also help with your live trading as well. Now backtesting, what you would do is on TradingView, now you'll have to get one of the memberships to use it, but with TradingView, what you would do is you would use the replay mode. With the replay mode, what you would do is you would go back in time. So like, let's say 2-3 months max. That's the maximum you can go in TradingView. You would go back 2-3 months, and you would basically look at live, and you would play it out, and you can do this multiple ways. You can test out strategies with your back testing. But for now, what you would be doing is getting in tune with the concepts. So what you would do is you would let it play, on 1 speed or even, half speed or even quarter speed. And then you would identify your concepts being formed. Identifying ICT concepts being formed, and not only being formed, but also how the market reacts to it while it's playing. So you're getting a real look at what price has done in the past and how it reacts to it. And you're getting in tune with it. When you do that, and then once we go over the models that you guys will be trading, and obviously you guys are going to be using these concepts right now without even me showing you these models, and I anticipate that on happening, but using backtesting with the replay mode and tape reading, this would get you in tune with what these concepts are and understand what they are. Because what's the point of using these concepts in a model if you don't even know what the concepts are? Okay? So understand that tape reading will get you experience, backtesting will get you experience, and live trading will get you experience. So doing all 3 of those combined with watching this mentorship will get you experience, and it'll speed up your trading process, getting in tune with trading way, way faster than you would if you only live traded and watched this mentorship. I hope you guys took notes. I hope you guys were listening. And if you need to watch this over again, please do. You can watch it as many times as you want and as many as you need to. I hope you guys have a good rest of your guys' day. And I will see you guys in the next video.